Okay. Dear colleagues, we are privileged at 2024 CER FinTech Symposium to have with us today a leading scholar in the Cardiff FinTech Research Group and a formal advisory panel member of FinTech Wells. His work is published in leading journals, for example, RF, GEF, and cited in the media such as Financial Times, Washington Post, Harvard Business Review, and Bloomberg. Please join me in welcoming Professor Arman Eshraghi.
Thank you. Thank you, Mustafa. We need to switch to, yeah. Good morning, everyone. Thank you, Peter and Mustafa, for welcoming us to beautiful Sundsvall, to Mid Universitet, and to CER. So, my friend and I, as soon as we stepped out of the plane, we felt a lot more relaxed, a lot calmer. It was amazing compared to London. So thank you. It is a pleasure for me to talk about something which I'm quite passionate about. The wicked problems of today require interdisciplinary, multidisciplinary approaches. I hope you agree with me on that. And today I'm going to talk about one of those multidisciplinary approaches. One of the research synergies which I believe exists in financial technology is when it comes in contact with behavior and financial behavior. Sorry, a small problem with the slides. I think we need the transition. Yeah. One of the problems with technology, of course, is that it doesn't always work. So you have to clearly keep calm. Yes, thank you. Thank you very much. Thank you. No problem. The core thesis that I like to talk about today and provide some examples for is that there's been an established body of work on behavioral finance and behavioral economics, as we all know. And the latest advances, the research progresses in this area, can very helpfully motivate research questions, drive research in fintech. And again, the recent advances in fintech can also shed light on what's going on in financial on behavior, on financial behavior. So the two areas, obviously both still very buzzing with activity. Once they collide, they can produce really fantastic research questions. And I saw, when I was looking through the program of the conference today, I saw many papers which I think could fall into this category. And of course, financial behavior and behavioral finance is not unique in that. There are other areas, other disciplines which also have a dialogue with fintech, including sociology, for example, including computer science, including AI, which again is a huge interdisciplinary, multidisciplinary behemoth. This is the lead article, the editorial of a recent RFS special issue on fintech. And one of the core arguments that the editors make in this editorial, which I would encourage you to read if you haven't, is, again, this emphasis on interdisciplinarity. And there are examples of research recently published in this and other leading journals which draw on behavioral insights to shed light on financial technology. So behavioral finance clearly has been established quite well in the past couple of decades with obviously with the awards of, amongst other things, Nobel Prizes to 3 leading researchers in this area. Daniel Kahneman, whose memory we should cherish because he passed away recently, of course, and Robert Schiller, Richard Taylor, for example. So we have quite a well-established body of work in behavioral economics and behavioral finance. And I would put it to you that a lot of that could actually be applied to what's happening in fintech in a very interesting way. This, for example, is a really helpful list of all the cognitive biases that exist in behavioral economics. There's about 150 of them. And when it comes to many areas of fintech research, such as cryptocurrencies, crowdfunding, peer-to-peer lending, etc., many of these biases are manifest. They show their face. And this, for example, again, is one of the articles published in that RFS special issue I mentioned, which focuses on the behavioral aspects of robo-advising. And again, we have some robo-advising papers in the conference today and tomorrow. So fintech presents many behavioral challenges, behavioral puzzles. One of the ones that fascinates me is obsession with newest technology. We all love newest technology, whether it's the newest shiny phone or the any gimmick or AI goggles or virtual reality, etc. And AI clearly is one of those things. So there's a lot of hype about new technologies. And of course, when it comes to fintech, I think that hype is significantly more because with finance, of course, comes the promise of making you very rich. So there's abundant wealth. And unconsciously, that drives people to become very excited. So we're going to talk about that a little bit today. When it comes to cryptocurrencies, as we know, and in fact, there is another paper in the conference today which also talks about this. The level of financial literacy is extremely low. So there are a lot of people who actually don't know what they're doing, but because of the simplicity of trading cryptocurrencies, they speculate, they buy on rumor, sell on rumor, and all of that creates a lot of instability, uncertainty, price jumps, etc. So what are the implications of that? And why is it that when it comes to assets like crypto assets, this is more manifest compared to, for example, stocks and bonds? That's very interesting. If we could tame this problem, if we could get rid of this challenge, then the cryptocurrency market could provide a better solution as a store of value. But unfortunately, at the moment, many crypto assets are extremely volatile because of this issue, amongst other reasons. So I'm going to talk also about a couple of papers that I was involved in. For example, this one looks at one aspect of fintech and behavior coming together. So we all know social trading platforms, right? These are fintech innovations which have been around for a while. So you could go onto them and sign up and start trading. These are some examples, and these are just examples. Of course, I'm not, with the disclaimer that I'm not recommending anything here. But so we could all go sign up, start trading stocks, and if you have a good performance, other people can follow you in a very social, in a social network setting type context, and they could follow you, they could like your performance, and if they're impressed, they could even invest their money with you, right? So then in a way, you become a quasi fund manager through these platforms. You can become a quasi fund manager. So yeah, so they've been, obviously there's technology involved because it's a platform, it gets rid of the intermediary in a sense, but there's also the element of investments. So we, in a paper published a couple of years ago, we focused on one of them, which is quite well known in Europe, called Wikifolio. And okay, so most of these platforms, the interesting thing about them is that they're very transparent. So from the moment you start publishing your trades, you can't go back. So it's all there. You can't delete anything. It's all publicly visible. So for example, this person whose ID is Trader Lady, we don't know who that is, but this Trader Lady currently has 600, or at the time this screenshot was made, had 600,000 euros under management, right? And she was doing very well during those few years. The interesting thing is all the positions are publicly visible, so you can see how many stocks people hold in which assets, which ones have done well, which ones have gone down. So red versus green, all in real time, right? And you can kind of scroll back and go back to day one. So see how people started trading from day one. Now, this is very different from typical fund management. Those of you who are from the fund management industry know that it's nothing like that. So in fund management, you can trade. Your clients, your investors don't know what you're doing until you publish a report every 6 months, for example, or every 3 months. And then at that point, you might disclose your top 10 holdings or some statistics in aggregate about your performance. But they never see in real time how you're doing, right? So then we thought, okay, so we have huge transparency here, sort of lack of transparency in the industry, traditional fund management industry. So what is the impact of that on performance? So that was the question. And so with this, so we talked to this platform. We got their data set, and we noticed that what happens is that transparency increases gradually. So at first, people sign up, they go through a test phase. Everything is hidden. And once they gain a bit of confidence, then they press a button, and then it goes to the second phase, which is published, and then it becomes investable. So from phase 1 to phase 2 to phase 3, transparency increases gradually. All right, so then we all know this thing called prospect theory from behavioral economics, which is the fact that when you make money, your happiness goes up. When you lose money, your happiness goes down, but it goes down more in relative terms. So losing $1,000 makes you usually 2 to 3 times more unhappy than gaining it would make you happy. So that's the loss aversion. And again, that in itself is dependent on where you come from, partly, what culture, what your background is. For example, can anyone guess which country is the most loss-averse nation in the world? Germany. So actually, it happens to be Russia. So for Russians, that coefficient is 6. So that means for the average Russian, losing $1,000 is 6 times more painful than winning it is enjoyable. On the other extreme, we have Australians. For them, it's about 1.5. So they're still loss averse, but it's 1.5 times. So if you have fintech investors from different countries, then you can actually look at this in real time, to what extent they trade and to what extent they're subjected to loss aversion. But specifically, we looked at something called disposition effect, which is the idea that if you have some stocks, some of them go up, some of them go down in price, right? We typically have the tendency to keep the winners, but sell the losers, right? Which is not a good thing, but it's just psychology, it's human psychology. Ideally, you should be completely indifferent. Forget about the price at which you bought, right? Just look at current valuation and current market price. But we are biased by the price at which we bought. So if a position has gone down in price, if it's red, we'd rather not sell it, because if we sell it, it becomes, the pain becomes physical pain. I mean, it's a loss on paper becomes a real loss. So anyway, so this disposition effect is something that we then measured through the proprietary data, and we noticed that it exists, but importantly, as the portfolios go through test, through publish, through investable, it goes down. So the level of the bias goes down. So here we have an example, and you can also see that in the negative interactions. So here we have an example of a fintech innovation reducing a behavioral bias, which helps people invest more successfully with better returns. So that's great. So obviously the paper goes into a lot more detail. In the interest of time, I'll move on to the next project. But the policy implication from this was that what we recommended in the paper was fund managers should report their performance more regularly, right? So rather than every quarter, maybe every month. And in fact, around the same time, SEC was moving towards that requirement. Of course, if you're a fund manager, you can't be expected to report your performance every day because it's too costly. Also, too much transparency would reveal your strategies. You don't want that, right? So there is a trade-off. But if you're an investor in a fund and not knowing what the fund manager does for 3 months is a bit giving too much leeway to the fund manager to make mistakes. So the spotlight helps, basically. So that was the lesson from this. Now, let me move on to the second project, which is work in progress with my colleagues at Cardiff, including Izzeddin, who is also here. So in this project, we looked at another aspect of fintech and technologies, and that's hype. So we all get obsessed with the newest, shiniest thing. And right now, for many of us, it's AI. Anything that has AI in it suddenly attracts attention. I've seen so many IPOs with mentions of AI in them, but it really, when you actually look deeply into it, the AI is not a major thing, but it's kind of peppered around the prospectus. This is one of the early OpenAI investors who actually warn against overvaluation in startup valuations. So, this paper got published a few years ago in Management Science, and what they showed is that during the hype of the blockchain in 2007, when companies put blockchain in their disclosures, their stock returns went up abnormally. And these were even speculative mentions. So a company which has nothing to do with blockchain, when it just mentions the word blockchain in its 8K disclosures in the US, the share price goes up abnormally, which shows that the market is too hot, okay? Or at the time it was. Now, of course, the level of hotness of blockchain has gone down a little bit compared to back then. This is my favorite example. I'm sure some of you have heard of it. A company called Long Island Iced Tea Corporation in the US changed its name to Long Blockchain Corporation. This was producing iced tea, but it got rebranded as Long Blockchain Corporation. The share price went up massively. Then it crashed. But then for several months, it was multiples of what it was before the cosmetic name change. So we call these cosmetic name changes. And there is, in fact, a branch of behavioral finance literature which focuses on cosmetic name changes, especially in fintech, because it happens a lot with fintech. Okay, and you see some of these papers here. Okay, so, but a lot of them focus on blockchain. So then we thought, what could we do differently? How can we actually go beyond blockchain and look at all technologies? So there is this concept in technology called hype cycle. So what is the hype cycle? The hype cycle is, from a psychological perspective, we go through hype. That's the first graph you see. Anything that's new, you overreact, and then your enthusiasm goes down. So that's the hype. But then we also have something called the technology S-curve, which is that any new technology, at first, the dividends are slow, but then it goes up. It goes fast because the technology attracts more investment. The technological hurdles are dismantled. And then it plateaus because the technology matures, other things replace it, other new technologies. So that's called the S-curve. And there's, again, a big literature in management technology studies on the S-curve. So combined together, we have this thing called the hype cycle, which means for any new technology, the level of attention, enthusiasm, market overreaction, if you like, goes through this up, down, and then back up again curve. And then a company, which is a consultancy company called Gartner, took this idea and then popularized it in the 1990s and commercialized it and called it the Gartner hype cycle. And this is the Gartner hype cycle. I'll show you some examples. So first of all, this is a very big company. It's part of S&P 500. And so this is the Gartner hype cycle. For any new technology, you can see that at first R&D levels are low, but then it attracts attention, mass media attention, early adopters start adopting the products, and then it peaks. Eventually it peaks. Then some early adopters will lose interest. It will go down to what we call disillusionment phase, and then it will go back up again because of the S-curve. Okay, so what the company does is that every year they go and ask people, technology experts, CTOs, investors, what they think about the level of hype in different technologies. So this is, for example, 2010. So in 2010, you can see the technologies on the hype cycle, right? For example, it's a bit small, but you can see 3D printing there in the technology trigger phase. So back in 2010, 3D printing was very, very hot. It was very hyped. I'm sure you remember, a lot of people were excited about 3D printing, and they thought 3D printing is going to change the whole world. Of course, that bubble burst. So after a few years, the 3D printing went through that hype cycle. Nowadays, probably we don't get that excited about 3D printing. You can buy a 3D printer on Amazon for a couple of $100s. It's not that revolutionary. Okay, so we can see all these technologies every year, and we can see how long it takes for them to go through the hype cycle. So these shapes you see and the colors indicate whether a technology is a fast technology, so it goes through the hype cycle pretty fast, or whether it's a slow one. For example, quantum computing is a slow burner. People have been working on quantum computing for decades. It is still probably will take another 2 decades to get to mass production. Okay, so this is 2015. In 2015, you can see 3D printing already past the hype, consumer 3D printing. This is 2020. Now, in 2020, the model predicted that generative AI was going to be on the rise. Most of us hadn't heard of generative AI back in 2020, probably, because OpenAI really got going in 2022, I think. So you can see that the model actually has been able, or the company has been able to predict some of these bets, let's say. Okay, so every year we have this. And so, just to give you an idea, this is the hype cycle for 3D printing, and you can see the share prices of 2 stocks, which are associated with 3D printing companies, large 3D printing producers, and they kind of follow the same pattern. And the black curve is the Google trend, the Google search, sorry, the green one is the Google search volume of the keyword 3D printing. So again, they also correlate, interestingly. Okay, so these are the top 20 most disclosed emerging technologies in our sample of about 12 years. And we also know where these disclosures are filed. So this is US data, but we are planning to expand this to other countries as well. We know where these disclosures are filed, of course. So it probably doesn't surprise you that many of them are from California, so kind of Silicon Valley area, but also Texas, which is now a rising tech cluster, and the Northeast, right? Now, let's say we have two companies. One discloses a hot new fintech innovation in Silicon Valley. Another discloses a hot new fintech innovation, let's say in North Dakota. Which one do you think would create more investor overreaction? The North Dakota one or the Silicon Valley one? Well, most people would think that, right? But actually, the thing is that you would expect companies in places like Silicon Valley to already be working on cutting-edge solutions. So that's already priced in, right? It's not, if Google puts out a statement and says, I don't know, we invested hundreds of millions of dollars on this new AI algorithm or whatever, it probably doesn't surprise you that much. But if a company in a place that you don't normally associate with being a very high-tech cluster, then if you hear that they have been doing something cutting edge, that, okay, according to our results, that attracts more attention from investors, and we see more overreaction, interestingly. So surprising disclosures, surprising locations, that's one of the interesting findings. Okay, so what we do every year, these keywords associated with technologies, we put them into a word list, and we do a bag of words search on the 8K disclosure every year for different companies. So we have thousands of companies, and we see thousands of disclosures, and we see when they disclose a cutting-edge new hype technology, and importantly, at which phase is the new technology. Okay, so what we find is that investors react positively in the short term to hyped technologies. So basically, hype pays off, unfortunately. So if companies play the hype game, if they put hot keywords, buzzwords into their disclosures, in the short term, their stock prices go up, right? Of course, we have seen anecdotal examples of this, but this is across all technologies. So it's the first time that it has been shown across not just blockchain, but across the whole set. But more importantly, we actually show that it depends where those technologies are. So if they're in the phase 1 and phase 2 of the hype, the overreaction is the strongest. So right now, if a company puts out a disclosure and talks about 3D printing, the market probably won't react as much. But if they talk about some fusion of quantum computing and AI and something which most people don't understand, probably the market's going to react because it's just so hot. Yeah. So that overreaction is clustered in those phases, and then we have a reversal as well. We also find that the overreaction is clustered in companies in surprising locations, in companies which have low analyst following. So analysts kind of ignore them in a sense. They are dominated by retail traders, not institutional traders. And in relation to our conference, especially fintech technologies tend to create the most overreaction and then reversal. Okay, so this is just some statistics, just some effect sizes on short-term reaction. You can see about 2 to 3% over a few days. Again, short-term reactions by phase. You can see it's concentrated on phase 1 and phase 2. And then we have the long-term reversal. Again, the long-term reversal over the next couple of months. And of course, we take care of all the other possible, we try to take care of all the other possible explanations. For example, we exclude corporate announcements related to earnings, other events, other macro events, etc., etc. We do placebos. It's not the traditional market sentiments like Baker and Bergler. Okay, so let me come to fintech. When it comes to fintech terms, so blockchain, peer-to-peer lending, crowdfunding, robo-advising, bank, insurtech, wealth tech, etc. When you look at these keywords, those that are hyped, they create about 5% abnormal return within 3 days. Right? I mean, that's pretty impressive, right? Whereas the baseline overreaction is about 2%. So when it comes to fintech, investors are more excited. Why is that? What is special about fintech which creates more excitement? So here are two hypotheses, and I'd love to hear your views about this. One is fintech stocks are harder to value because they're not tangible, right? It's not, again, if a company does 3D printing, it's easier to value because it's, again, a tangible product. You can see what's the bottom line on each 3D printer or the impact of the 3D printer on an industry. Whereas, again, things like blockchain, decentralized, let's say, exchanges, they're far more difficult. And because of that, because they're harder to value, they're more prone to behavioral biases, including investor overreaction. So this is one theory, let's say, published in JFQA. Another goes straight to psychology, and that's the fact that with fintech, you have the promise of abundant wealth. So anything that can make you rich, and you can see that it can make you rich, you just overreact to it. Now, this also applies to technologies which go very fast through this curve, so less than 2 years. So if we create a dummy variable called quick adoption, and that's technologies which go to mainstream less than 2 years, that dummy variable loads significantly. So again, investors overreact to those sorts of technologies. As mentioned, investors overreact to technologies that are disclosed by companies in surprising locations, such as, for example, places outside the typical technology clusters. For example, it's not the Silicon Valley driving our results, but it's the non-Silicon Valley area. It is not the NASDAQ firms which drive our results, but it's the non-NASDAQ firms. And also we run tests on information asymmetry, etc. So it's firms which have a higher information asymmetry, lower lower institutional ownership, and so on. So okay, so this was yet another example of, and by the way, this is work in progress. So this is yet another example of how behavior and fintech could come together to create a research question. I would like to thank you for your attention, and I look forward to hearing your thoughts and views. Thank you.
Thank you so much, Arman, for the presentation. Now we will have time for question Q&A.
I must say, I'm not anti-AI at all. I love AI. But all I'm saying is that from a behavioral perspective, you see a lot of hype in this market, and you just have to be aware of that hype. Yeah.
Yes, please.
Yeah. Yes.
But is it indistinguishable from what we have already private equity?
Yes. You're absolutely right. So FOMO, fear of missing out, is very key, and there are some papers in this area which build on FOMO theories or models, spillovers. I think theoretically it's indistinguishable. However, when it comes to practice, many fintech innovations are more available to the masses of investors compared to private equity. Your average taxi driver probably doesn't invest in private equity, but a lot of them have Bitcoins on their wallets. Because it's just much easier. I think in the public sphere, there's much more discourse on, for example, again, cryptocurrencies and other forms of fintech innovations compared to private equity, hedge funds, etc., which are more exclusive. So I think it's that element. Unsophisticated investors probably are more prone to investing in certain assets compared to others. That would be my view.
Yes, thank you. We can have the second question. Yes.
Thanks a lot for your presentation, but actually for the second paper, I'm really keen on, okay, let's say the firm put, let's say, some fascinating words in the announcement or any disclosure, and let's say the public might overreact to the stock return,
Yes.
stock price, okay? Do you have a chance to look at, okay, the dynamics, how can I say, like, the numbers of works putting in that through the trend, why? Let's say, okay, I'm an investor. I know that the firms reveal that information can bring me, okay, 5% return, right?
Yes.
Then all the firms in the market, they can exploit that strategy.
True.
To put these fascinating works in. And from time to time, let's say, on an investor, they can correct the belief later on. But how the firms still have that strategy throughout the long term. So my hypothesis could be the old investor, they might go away. And the new abnormal return come from the other firm, or when later, come from the new investor. But it's really puzzle to distinguish. That's right.
Yeah, no, I see. I think, okay, so I think, great question. So you're saying, why has it not been arbitraged away? And I think your own response was, it looks like a Ponzi scheme. So there's no more money coming in, which keeps could be that. You're right. I think, at least in the research literature, so far, the effect hasn't been shown universally. So we know anecdotal examples of companies playing this game, but we haven't seen the effect being shown, in published research yet. Usually when these papers get published, then the effect sizes tend to go away. So we'll find out. There is an element of Ponzi, I think. Yes, there is an element of Ponzi. But of course, there's a lot of legitimate interest. It is a revolutionary technology, for sure. But unfortunately, there's also so much layers of hype. So all the companies that mention the words without really using the technology are creating too much noise. So the legitimate technologies, the companies that are actually legitimately should use the keywords, are kind of lost in all of that. And I think that's the problem we're facing at the moment. With AI, we had the same thing with blockchain, with cryptocurrencies. Yes.
No, it's on the same topic as what the gentleman just asked, and I'm very interested in when it says a 5% or 2% abnormal return, or 5% abnormal than 2%. A hype, I would imagine, would be in a firm that's fairly small and immature, and maybe even size-wise, market cap small. Is it possible for an institutional investor to capitalize on that, or would that make it go away?
Yes. Okay, so I think we did a run. Izzadin can correct me, but I think we did a run where we looked at within sample buy and hold returns of of this strategy to see whether we can create abnormal returns over time. And I think we did. But then you have to factor in transaction costs. And as you say, these are some of these are small companies. It's a bit difficult to factor in transaction costs. Yeah. It would swing them. Yes. Yeah, I agree with you. Yeah. So that could be partly the reason why it hasn't gone away. Like other small pockets of yeah. No, fair points. Fair points. Hi, Charles.
Thank you very much for your very interesting presentation.
Thank you.
The approach of the Gardner diagram is very interesting, and indeed I have forgotten it. It's good that you brought it us. You know, regarding your question, I'm thinking of the following. Whenever it comes to these new questions, always my mind goes back to the classics. And I remember what John Maynard Keynes said almost 100 years ago. He said that the good speculator is the one who guesses well what the average opinion thinks that the average opinion will think.
Yes.
I think this is a very good departing point. And I think you gave it the answer yourself when you said that perhaps the extra hype may have to do with the fact that fintech has been much more widely understood and ingrained into the investors' minds. And I think that is exactly what Keynes also meant in this respect. You may use it as a backup. So probably to measure it, if you could get some variable that measures the extent to which fintech is ingrained in different societies, then might be a very good explanatory factor of your extra find.
Thank you.
Thank you.
I agree. I think that would be fantastic if you had a metric or variable that would measure the social integration of fintech. You're right. Your quote of Keynes, again, very to the point. It reminds me of another Keynes quote, which says, markets can remain irrational longer than you can stay solvent. And again, we can say all these people who want to ride the bubbles. I was tempted very much to actually ride some of these AI stocks myself, but it's you never know when to get out, of course. So that's difficult. Yeah.
Thanks for your presentation. It's very useful. Now, fintech is very broad, and you talk a lot about the hype in the past. Do you think that the topics of research in fintech areas also followed those hype in the past? And what are the new hype in the foreseeable next 5 years that you foresee in the research area of fintech?
Oh, okay. So that's a difficult one. I know that a lot of researchers are turning their attention to quantum computing and what impact it will have on the market microstructure. In fact, as I'm sure many of you know better than me, some say quantum computing, once it becomes powerful enough, it could potentially endanger the cryptographic security of blockchains, potentially. So there's also that, clearly AI. If we reach what they call AGI, artificial general intelligence, I think that would be completely new territory, and it will impact everything. So again, that is another thing to watch out. But like you, it's a very fascinating landscape, and I'm going to hear a lot of the papers today and tomorrow and try to learn more about what's cutting edge.
Yes, thank you so much. Thank you again for. Unfortunately,
thank you.
Yes, thank you so much, and thank you for colleagues who are following us via YouTube channel, Mitsuri University YouTube channel. Thank you very much.
Thank you. Thank you so much.
Thank you.
My pleasure.
Thank you.
Thank you.